Hello and welcome. I'm RealCrowd CEO Adam Hooper, and this is the Real Estate Investing for Your Future podcast. Here we explore the latest in commercial real estate trends, insights, and investment strategies that passive investors can use to build real estate portfolios that last.
All opinions expressed by Adam, Tyler, and podcast guests are solely their own opinions and do not reflect the opinion of RealCrowd. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. To gain a better understanding of the risks associated with commercial real estate investing, please consult your advisors.
Our special guest today is Brian Beaulieu, the CEO of ITR Economics. ITR provides economic forecasts to reduce risk and drive practical and profitable business decisions for their clients. Since the 1980s, ITR has had a staggering 94.7% accuracy rate with their forecasts. In today's conversation, Brian shares his latest forecasts on the national and global economies, where the opportunities are for business owners and real estate investors, and provides a preview of a recently recorded webinar where you can hear a much deeper dive on their forecasts over the next 10 to 15 years. Be sure to check the show notes for links to that webinar and other resources that we discussed, and we hope you enjoyed today's conversation with Brian Beaulieu of ITR Economics. Well, Brian, thank you so much for joining us today on the show. We are super excited to have you on. We've had Jackie on from ITR in the past, and we're thrilled to get to chat with you today on the show. So thank you again so much for your time and talking about everything that you guys have going on at ITR.
It is my absolute pleasure. Thanks for having me on.
Perfect. So previous listeners have probably heard a couple episodes that we've done with Jackie Green in the past, and if not, we'll put some links in the show notes there. But for new listeners of the show, why don't you tell us a little bit about what you're doing at ITR Economics, how you got started and how you started the company, and a little bit of history of what you guys have been up to over there.
Well, at ITR Economics, we focus really exclusively on working with businesses, forecasting economic trends that impact those businesses, and not speaking in eco-speak, but translating it into the world of business to come up with what we call management objectives. Is it time to do this? Is it time to hire? Is it time to not hire? Is it time to make that CapEx? Where are prices going to be going? Those sorts of practical, profit, bottom line oriented decisions that leaders have to make every day. I didn't start ITR Economics. It started in 1948, which was before I was born, fortunately. I joined it in 1982, and I bought it in 1987. So that's my history with it.
Okay, so taking not just the forecasting side of things, but then translating that into actionable business intelligence, right? I think that's a gap that's often missed in how to make sense of the research that's done and how to make sense of those forecasts and the economic data. So that's what you guys are really into, is trying to translate that into actionable intelligence, right?
Exactly. So profitable, actionable intelligence. That's the name of the game. And toward that end, sometimes that's a 6-quarter forecast, sometimes it's a 3-year forecast, and sometimes, as we just did, it's a 15-year forecast.
We'll talk about that today. You guys just recorded a great webinar. Again, we'll have links in the show notes. We won't tease a title just yet, but let's talk a little bit before we talk about the title and maybe what the content of that webinar was. Since you've been involved, again, you said you bought the company in 87, been through a fair number of cycles since then, and I've always been just absolutely shocked at your accuracy rate. So you guys have a pretty good historical track record of these forecasts and this intelligence, don't you?
Oh, we do. And I think that's multifactorial. One is we are apolitical. We're not tied to any particular product or service, so we don't have an agenda from that perspective. We don't make any more money or less money, whether the economy is growing or not. We make money when we're right, and that's all we really, really care about, is getting it right. So when you apply some critical thinking along those lines, it works out okay.
And how right have you guys been?
Well, the long-term accuracy is 94.7% over the last several years, though it's been more like 98 to 99%. 2020 obviously threw us a curveball. We didn't have our normal 12 to 18-month horizon because came March, I think it was, February 2020, all of that just got blown up. And we were scrambling in March to redefine all those forecasts, which we did. The end of the year came in on our 8 benchmark items with about a 98.2% accuracy rating. So we adjusted well on the fly.
That's pretty good for as much of a disruption that was, and we'll talk about that a little bit. Wanted to also lay a little bit of groundwork in terms of the economic phases that we talk about before we get into that, because we'll kind of reference back to those. Can you run just really quickly through how you guys look at those different cycles or the different phases of that cycle?
Sure. There are 4 phases to every typical business cycle. A is when we're recovering off a trough like we were in 2020. B is when we're running above year-ago levels and the slope is accelerating in the rise. That's the best phase of the business cycle. That's 2021. C is the cautionary phase. It's where the data is still rising, at least initially, but you're slowing in the rate of rise. So caution is warranted. And oh my gosh, it's so often you see businesses extrapolate their phase B, that accelerating rise, and they're opening plants at the very top of a business cycle. History is littered with such occasions. And frequently, C turns into D, which is the overt downward phase, the most negative phase of the business cycle. Now, you don't have to go through all 4. There are times when the economy will slow down and then reaccelerate. And that's what we think is going to happen. 22 is slowing down, and on into 23, the economy is slowing down in phase C. And then we think in the second half of the year, we're going to see it flip from C back over into B, what we call a soft landing. And those happen not infrequently. They're, more the exception than the rule, but you can spot those coming also.
And then when we had Jackie on last time, and we'll talk a little bit about your webinar and forecast here, I proposed a phase E, which is a depression, but it sounds like that maybe, or I don't know if that's stuck from our talk before. So they don't have to go, and that was one of the things that we talked with Jackie last time, was the phases. They don't necessarily go A, B, C, D in sequentially, right? They can kind of bounce back and forth from time to time. It sounds like that's maybe what you just mentioned, was you'll see a period of maybe slowing growth here in 22, maybe 23, but then going maybe back into this phase B, accelerating growth. So they don't have to progress sequentially. They can kind of bounce around a little bit.
No, absolutely. And obviously for a company, the name of the game is, I don't want to go into phase D, and I don't need the recovery phase. And you have a choice, right? You always have a choice. Am I going to avoid that downward phase in my profits, or am I going to avoid that downward phase of the cycle in terms of my top line? And that's a fundamental choice that we talk to people about as we're cresting the top of the business cycle. All right, what strategy are you going to employ here? Is it about your bottom line, or is it about your top line?
And it sounds like you work with all different industries, right? It's not necessarily focused on one sector or the other. So how do you, those are different markers, different factors that go into those decisions depending on what industry you're in, right? Construction or home building might be different than, retails or product manufacturing. Do you provide, are these industries specific, or do you generally work with a client, dig into their specific business model? How does that work from a practical perspective? I'm curious.
Well, two ways, actually. If a trade association is hiring us, then we know the market that we're dealing with, but we're not going to get company specific, because we're going to talk about the general markers for their industry, their customers, that sort of thing. But bread and butter for us is when we're dealing with a company, looking at their particular needs and working to tell them what we think they need to know, not what they want to hear necessarily, but what we think they need to know to adequately plan for the future.
So now let's talk a little bit about the pandemic and maybe some of the metrics and trends that you were tracking prior to, and then some of those adjustments that you made, like you said, on the fly to end up the year at that 98.2% accuracy. What were those things that got disrupted and distorted, and maybe how did you look at some of those trends differently given what we learned in the early part of the pandemic?
Well, everything got distorted and disrupted. The leading indicators, just before 2020 came around, the leading indicators globally and the U.S. were starting to turn around. I don't know if you recall, there was definite softness in the economy in the fourth quarter of 2019. And we saw that coming, and we saw GDP being weak in the first quarter of 2020, even without the pandemic. It just obviously got a whole lot worse. But the leading indicators are already coming around. So from our perspective, one of the big disruptions, if you will, was those leading indicators all of a sudden went into crash mode. There was no longer forming a J at the bottom of the cycle. So our next task became, what do we do with this, right? We made the conscious decision to think about the pandemic as a natural disaster. It was not an economic disaster, and it was a natural disaster that had economic, political consequences. And once we did that, then we had some paradigm. We could go back and we can look at smaller natural disasters like Superstorm Sandy or any number of hurricanes. And we could extrapolate from that to first the U.S. scale and then the global implications of what we were looking at. And that provided us with a great construct from which to gauge things. And then that also allowed us to take a look at all the stimulus that the government was applying, not only just the checks being sent out, but all the other acts, care packages that were going out, if you will, and the Federal Reserve's stimulus, monetary policy stimulus. And understanding that it was a natural disaster, that the economy wasn't broken, enabled us to anticipate, holy cow, they are going to massively stimulate demand without a supply chain there. And therefore, we're going to get all sorts of amazing distortions in the economy, unbalanced aspects of the economy, and a lot of unintended consequences are going to be derived from this. And it all stemmed from our realization that, look, the economy isn't broken. It just was told to turn off for a while. But they treated it like it was broken because when you have a hammer, you only know how to view everything as a nail.
Everything's a nail, right? So we have this massive demand spike without the supply capabilities to really keep up with that. And I think we're probably still feeling the effects of that, right? Like we were just out taking a look around at cars over the weekend, and boy, that's a very different environment, right, than what it was before. And there's so many industries like that are just, the supply chain has been completely bonkers throughout, right? So are we still feeling that effect? And how long, I guess, until some of that supply normalcy comes back, or will that be a much longer term disruption, do you think?
It really depends on the market that you are looking at. The normalcy is beginning to return when you look at volume of imports coming into the United States, but then again, you can see that there's some port issues because of the Delta variant in China. So we're clearly not past the storm there. You mentioned the car market in particular. It was interesting. So much of the chip problem for those cars, yes, it's a COVID disruption, it stimulated the demand, but the chips were a problem beforehand because the industry made that decision years ago that they were going to assume the newer and newer chips were going to be going into these cars, and the designers, the engineers, decided they were going to stay with the old chips. So we ran out of supply in the old chips, not the brand new chips. So those are the plants that are being built today. Is to handle previous generation of chip. We're building them abroad, and they're being built here in the United States. Those plants come online over the course of 2022 and 23, and that'll probably be the tail end of the supply issue. Really late 22, early 23. And we think that's a critical aspect of why the economy can finally begin to heat back up in the second half of 2023, because we have these supply chain issues rebalanced, and it'll be a much more smoothly flowing economy then.
Okay. One of the things that we also talked about quite a bit last year was the sense of the pandemic being an accelerant to a lot of these trends that were already underway, rather than necessarily creating new trends or new factors that we didn't necessarily think about before. It was more of just amplifying things that were already afoot. I'd love to get your perspective on what were some of those major trends that you saw accelerate, and did you see any new trends that you guys are tracking now as a result of the pandemic, maybe that you weren't thinking about or thinking about differently now than before?
Okay, for the first part, the acceleration very easily discernible, for instance, in office space, being on a decline because of distributed workforce or disseminated workforce, and that's clearly got accelerated. And now we're seeing that trend level back. It's certainly heightened from where it was pre-pandemic, and it's not quite as crazy as it was during the pandemic. But this is clearly a different workforce environment than we've had before. The level of mobility in the workforce has clearly gone up. And that's changed some of the real estate trends, right, in these major cities and in some of the more popular outlying areas around those cities. E-commerce clearly was given this huge boom during the pandemic, and a lot of baby boomers, my generation, learned how to make do with e-commerce because of the pandemic, and they liked it. They're not going to go back to the other way, which means department stores, which were always the poor sister in the retail market over the last 20 years, they're going to continue to struggle in a lot of different areas. So those trends were accelerated, not really new. I think what opened our eyes more than anything, it's not that it was new per se, it's just that we had not observed it as finitely, was the radical departure in the deficit spending trend. Now you can say, yeah, it was caused by the pandemic. I get that. But when we analyze that trend, it really began in the 1980s. And this is the research I was doing the last time when we were supposed to get together. And people have a tendency to think one political party versus another political party is better or worse at managing the deficit and therefore the national debt. Lo and behold, most of those misconceptions are nothing but political rhetoric. We looked at how many times the Democrats reduced the national debt. We looked at how many times Republicans did. You know what? It was even. And by the magnitude of decline that they invoked, that was even also. When you looked at who's more likely to increase it, you're going to be hard-pressed to show that there's, outside of wars, that Republicans are virtuous or Democrats are virtuous in that regard. They're just politicians. And to us, that really sealed the deal when it came to understanding where we were going with this deficit spending and what the rest of this decade is going to look like as a result, and what the consequences of that are clearly going to be down the road.
So that's maybe a good segue into nationally what you are following and what these factors that you look at. So deficit spending, obviously one of them. You said e-commerce was another one. Obviously you're watching. What are some of the more macro factors, I guess, that you guys are tracking nationally, and what are you seeing just generally in those right now?
One of the macro factors we're tracking, because it led out of the downturn, was housing, single-family housing starts in particular, but multifamily is coming around now also. And one of the big question marks was all that price rise in housing. Was this a bubble, yes or no? And if it is a bubble, how bad is this going to be? And finally, when is it going to get bad? It is a bubble because of all that stimulus and because of the shift towards staying home and the rest of it. We've clearly created a bubble in the housing market. Is it going to be like 2006, for instance, and anytime soon? No, not even close. The markers aren't there. We're not looking at the same level of indebtedness. We're not looking at any of those past due numbers. We're looking at a consumer that I know you hear otherwise through the politicians, but the corporate and consumer balance sheets are actually very good shape right now, all in. So this bubble in pricing is going to continue for another couple of years anyways, is our best estimate. So you don't need to be worried about the slowdown in 22 turning into something nasty when you have some markers like the housing market continuing to look robust, when you have disposable personal income at the consumer level still running above pre-pandemic levels by a wide margin, a lot of money saved in bank accounts across this country, consumer perfectly happy, willing to spend that money. Those aren't signs that you're going to be looking at a deceleration turning into a decline in the economy. And those are really rock solid cornerstones, really, of the economy.
Mm-hmm. And then you mentioned, you mentioned deficit spending, but inflation is obviously, that's a big one that everyone's trying to figure out right now, with all the money that was pumped in the economy. How are you thinking about inflation at this time? There's a lot of concerns out there. I think that's one of the reasons why I think real estate has been an attractive investment vehicle for a lot of folks, is it's a fairly decent hedge against that in the case that we do get into some inflationary pressures. But how are you seeing inflation right now?
We see it as transitory, very similar to the Federal Reserve. We understand, and we get it from our customers, our clients, that they have felt a lot of inflation in their raw material prices. They've been needing to pass that through, and they think this is the beginning of that monetization, that monetarized inflation because of all the stimulus. And our answer to them is, that's not what the Federal Reserve sees. That's not what the bond market sees, because we look at that bond market every day. And that's not what we see in our leading indicators. This is truly transient. You're going to see the consumer price index, the producer price index follow the trend of copper, follow the trend of gold, and they're already on the backside of this cycle. So you're going to be looking at disinflation, not accelerating inflation, until we get into about 2024 time frame. That's when you're going to find more and more systemic, potentially monetized inflation coming about. One of the consequences of all the stimulus that's been laid out there is we don't have workers. The manufacturing sector, you mentioned them before, there are 870,000 manufacturing job openings in the United States today. All right.
I'm sorry, how many?
870,000.
870. Okay, I heard that right. Yep.
I know, right? I mean, there's no possibility of filling all those positions. So we're going to be automating. We're going to be putting in AI, machine learning applications wherever we can. But one of the consequences of that will be someone's going to start crying about or complaining that we're using technology to rob people of their jobs, when the reality is we can't find the people to take those jobs.
Right. Which that's a pretty big disrupt, right? And I think that's something that has been talked about forever. Again, this robot revolution or whatever hasn't really happened at the scale that I think it's been feared. But sounds like with 870,000 openings, there's a need for that to fill the supply. Again, that we talked about, that supply gap that's just not there right now. It seems like there's room for some automation improvements to be able to just start to bridge that supply gap, right?
Oh, absolutely. You're absolutely right. We think one of the best ways to protect your bottom line through the rest of this decade is to make sure you're making those investments in automation, obviating labor to the extent that you can, because labor is going to be a key component of inflation, your company's inflation, systemic inflation, and the more you can reduce that variable's input into your profitability, the better off, the stronger you're going to be.
Mm-hmm. And then what about interest rates? Obviously, we're in the real estate world, so that's a very interest rate sensitive market, and we've seen them stay pretty low here. Certainly on a historical perspective. With housing rates, single family mortgage rates have come down again, I think, just recently here. How are you feeling about interest rates? What are you looking at there? What are you forecasting for interest rates going forward?
Well, the bond market and the Fed are both saying that interest rates are likely to remain low through the end of this year. The Fed says even in 2022. That may be a little bit optimistic. Wouldn't be surprising to see a 50 basis point rise in long-term rates over the course of 2022. Because of that webinar that we've obliquely referenced a couple of times, we did a long-term forecast of the 10-year bond yield, U.S. government bond yield. And we had to make a fundamental assumption. The assumption was this: the U.S. dollar will remain one of the most favored world reserve currencies. Mm-hmm. And for that reason, you don't find any crazy rates of inflation, or interest rates rather, like we saw in the early 1980s, if anybody listening can remember that far back. remember, that's when we had prime rate at 13% and that sort of thing. We don't see that happening as long as we can maintain our global reserve status. But that's being chipped away at as we speak because of the digitized Chinese currency, because of the Russians declaring they're no longer interested in holding dollars, Pakistan, Turkey, peripheral economies declaring that they're going to go with the Chinese yuan, not US dollar, as their secondary currency. So you see some erosion is happening. So we're watching that very carefully, because if that continues, that erosion continues, you're going to see much higher interest rates than we're currently forecasting. We think today's 10-year bond yield is going to go from about 1.3, 1.2% up to about 6.2% at its high. That alone is going to be very, very expensive for a government that's increasingly in debt. But it's not, in and of itself, ruinous type interest rates. It's not like a replay of the 70s into the early 1980s.
And do you see, we'd be remiss if we didn't see if crypto plays into that at all? Do you think is crypto going to knock off the dollar as the global standard?
Not the cryptocurrencies that we have today. And China's also shown us that too. The U.S. will follow suit. Why would any sovereign government give up the right to control monetary policy? They won't.
It's going to be a tough one.
Yeah. And there's no way the free market is going to overwhelm the industrialized nations of the world in terms of that policy.
So then looking globally there, monetary policy one, what are some of the other more, I guess, kind of bright flashing metrics that you guys, or trends that you're looking at globally right now that are on the radar?
An aging population is huge, obviously. As the population on planet Earth, including the United States, gets older and older, we consume more and more resources without contributing commensurately into the economy. And in many countries, there's just not enough younger people to make up for all these old people. Fortunately, the United States is in pretty good condition compared to, say, China or Japan, or even our neighbors to the north, Canada. The Millennials, the generation underneath the Gen Xers, they're the single largest generation the United States has ever had. So few countries can say that. That's extremely powerful economic mojo over the longer term. I mean, it's one of the reasons why the U.S. is going to remain the preeminent economy for the next 100 years.
And then, so if the U.S. is somewhat protected from that, I guess globally that's good. Are there other trends that we might not be as protected from, I guess is the question.
Yes. Yeah, there certainly is. It's called healthcare.
Yeah.
Here in the United States, we have this
Which
culture.
is interesting. I mean, that's an interesting dynamic, right? Healthcare, if we have one of the younger generations, and healthcare in the U.S. is maybe not what it is in some of the other developed countries, we might not be immune from that, but that might be delayed. Do we have time to fix that? Do we have time to solve that before this millennial generation gets here, or are we already in the middle of it and it's kind of...
You're already in the middle of it,
ball.
Because all of us baby boomers, we want whatever it takes to live as long as we possibly can, regardless of the economic cost-benefit analysis. That's part of our culture. And we believe we have a right to those next 6 months of our life, no matter what it's going to cost. And that's really not up for debate, I find out frequently when I mention it at the wrong time. That's a U.S. position. That's a U.S. phenomenon. And it's why our healthcare costs are what they are, more so than the fact that we pay more for our drugs, and that our hospitals are relatively inefficient, et cetera. It's the demand curve not being connected to the cost curve that is ultimately at work in driving up U.S. healthcare costs.
And is that, do you see that getting worse as the millennial population ages, or is that still a little too far to be able to forecast with that? I mean, there's still time,
I see it getting worse until 2036, because by 2036,
remarkably specific.
That's when the majority of us baby boomers are dead. and therefore the problem starts ameliorating post-2036.
Post-2036. Okay. Well, let's maybe see if we can get back onto a more positive tone then. Are there any other interesting areas, or maybe we try to wrap up our episodes, and we've not right now, but we've got a lot more that we want to chat about. But maybe just looking nationally and then globally. What are some of the bright spots, right? What are some of those things that you're optimistic about? And then, or maybe let's start first with what keeps you up at night nationally and globally, and then we'll switch that to what are you excited about? What are you optimistic about? How about that?
Well, I think we already touched upon what keeps me up at night. It's our U.S. national debt, and we've developed this thinking. It's not new. It's rehashed modern monetary theory. That says we can run up as much debt as we want because we're the United States, we're the world reserve currency. That doesn't work. It never has worked, but that doesn't stop people from regurgitating that same theory from time to time. And they'll put different window dressing on it. There was an interesting paper done, Princeton published it. It was called 800 Years of Financial Follies. And it looked at tipping points in economies. And they noticed that when national debt reached 80% of a country's GDP, nominal GDP, they went past the tipping point that they could not recover from, that there were consequences from that point forward. And we did that, by the way, in April of 2009 here in the United States. And one of the consequences, if you look at it, is that ever since the Great Recession, as our deficit spending has increased, national debt's gone up higher and higher. We're now at about 127% of GDP. Our ability to grow as an economy from over a 10, 12-year span of time is no longer what it once was. And you can see that same scenario being played out. It happened in Japan before it happened here in the United States. There seems to be something to that particular tipping point. That keeps me up at night. And we just don't want to change our ways. But let's talk about what the good things are. The good things are the millennials are a huge population. They think differently than Gen Xers and baby boomers. And they are going to be the ones that will adopt new technologies, new ways of doing things, new ways of looking at things more readily than the Gen Xers would have been willing to do. And with that adoption of the new technologies, you're going to see the creative destruction forces that Joseph Schumpeter talked about really come to fruition. We're going to be creating new industries, new jobs at a phenomenal pace because we have that young population base, more so than any other industrialized nation on this planet. So that's one of my, okay, I'm not worried about the future. We got these millennials there, and amazing people.
You might be the first person to say millennials are our savior. That's very counter. It's very counter narrative there.
No, I'm sorry. The second thing that makes me very confident about the future is that we have been mightily blessed with natural resource base that is beyond par. I mean, China has a relative paucity of natural resource compared to us. China's demographic is negative. Ours is positive. There's no comparison between the two on those two scores. And history is very clear. Nations that own the natural resources, they really control their own fate, particularly when you're going through a period of inflation like we're going to be going through over the next 10 years. And the third factor that still remains true, although you could argue that there's an ebb and flow to it, but we are still a nation of laws. You have to have intellectual property rights, you must have personal property rights, and you must have bankruptcy laws if you are going to be a long-term player. And who else but the United States has the demographics, the natural resources, and has a rule of law system in place? No one. And it doesn't get any better than that as far as I'm concerned.
I like that. We'll take the good. Let's switch a little bit over to cover some of the specific industries that you're focusing on. Maybe just a quick hit on both what you're seeing global and national. And we'll start with manufacturing. You mentioned that before. Almost 900,000 openings right now. Bigger picture, how is manufacturing looking, and what are you guys following there?
Bigger picture, manufacturing is looking very good. There is a shortening of the supply chain that is going on, will continue to go on. It's part of the Biden administration's fiscal policy, but it was going to be going on anyways because of what the world learned going through COVID. We are going to see more and more nationalism play out going forward also, which is the opposite of globalization. And that will ultimately breed some inefficiencies, but in the short term, like the decade, you see more and more manufacturing and related opportunities going on. Onshoring, near sourcing, those trends are very much alive and well. And except for 2020, the number one destination of foreign direct investment year in and year out is the United States, and that's not about to change. So we're bullish on manufacturing going forward.
And that's what you mentioned even with the car chip example, right? Now starting to build some of those plants here domestically to fill some of that supply chain, whereas historically those have always been or manufactured overseas, right?
Correct.
How about finance?
Finance. That's a big, broad topic, finance. Are we talking about banks? Are we talking about financiers?
Financial services industries, how about?
Okay. They're going to be going into an interesting time, in our opinion. One thing we haven't talked about is our forecast that the U.S. dollar is entering into a prolonged period of decline. That's part of what gets you systemic inflation in the future. That prolonged period of decline in the U.S. dollar is inflationary, and it's going to shift emphasis away from stock market to some alternative investments. So financial advisors and services firms that understand that shift and can break away from the paradigm of the last 10 to 12 years into a new paradigm that has a weakening U.S. dollar, they are going to clearly be worth their weight in gold to their clients, their customers. Those who can't, who continue to look for yesterday to repeat itself, are not going to be faring well. So I think you're going to see a shakeout in that industry between those two, the ones who can see the future and those that are clinging to the past.
Yeah, that's definitely interesting. And we have a subsidiary that is an RIA, and we've been hearing a lot of those same conversations, certainly within the financial advisor, wealth management space, of trying to figure out how can they make a portfolio that they forecast, 5, 6, 7% return when bonds are yielding a fraction of that, right? A lot of their models have been blown up, and they're searching for some of those alternatives like real estate and some of the other asset classes that are out there to supplement that. So yeah, I think that's definitely something we've seen firsthand as well. Construction, that's something, that's been an interesting one, right? With just the raw costs going up. Obviously we saw lumber spike like crazy. We've seen a number of projects actually get shelved due to rising construction costs. How are you seeing that forecast for, I guess, just raw goods for construction, and then also labor is a huge part of that too, right?
Yes, labor is a huge part of that, although I've been impressed with some of the inroads the construction folks are making to not needing as much labor on any given site. That is a very important trend that we've seen out there. Non-residential construction, which I think is what, or at least that's what I inferred, I implied, or that's what I heard you talking about, sorry. That's a lagging economic indicator, and that'll be starting to come up, toward the end of this year. You're going to see more and more non-res construction begin to take off. Probably not in terms of brick and mortar retail, like it used to be defined, and not in office space like it used to be defined. But overall, that segment starts coming along and doing well. And it'll continue to do well in 23, 24, and 25. It'll be on its upswing. State and local governments weren't nearly as hard hit as we feared that they would be. So that bodes very well for educational construction, bonds being let for those purposes, and that's good. That's turning around sooner than otherwise. Manufacturing construction ties in with CapEx. CapEx is rising as we speak, so manufacturing construction is turning around as we speak also. So the the signs are there that it's going to be turning around and it'll be back to business as usual. Now, we all got a little lesson in inflation in our commodity prices, right? And like I said before, they're settling back down, but hopefully people learned how to handle those. One of the biggest follies we saw were emergency contracts being signed at these high prices instead of taking a more measured, hedged approach. If I was a construction company dealing with a lot of these raw materials, you know what I would be doing? I would be contacting the best hedging company I knew to manage these costs going forward. That would be a really smart thing to do.
And then before we talk about how these are all tied in, which you kind of mentioned there with construction and CapEx and manufacturing, for the service industry got crushed in the pandemic last year. Once things started to open up, we saw a big flush back in of those jobs. How is the service industry looking? Are we out of the weeds yet? How's that coming back? Are any longer term changes that you're seeing in the service industry?
We are out of the weeds, mostly. Business travel isn't back where it used to be, but that's turning around. Family type travel, vacations, restaurants, venues, those are opening back up rather nicely. The only hesitation I have in that regard is the Delta variant. I can't forecast where that's going. In the United States, I can see the numbers, and it's not nearly as big a deal here as it is in other parts of the world, clearly. But we're sort of holding our breath watching those trends.
And so then how do you look at interconnectivity between those different industries? Are there some that are more siloed, or do they all feed off of one another? Do you see one more as a leading indicator of others? What's the interplay like between those major industries that you guys follow?
There are definitely leading indicators, and if you're looking for an industry segment, that'd be a leading indicator. For instance, it'd be housing starts. But in terms of the larger question, at ITR Economics, it's funny, to this day, we want to hire economists who have a background in music. And that was our founder's thing, Chapin Hoskins. He was not interested in hiring anybody who couldn't understand that the economy is one big symphonic movement, and you can't focus on the woodwinds to the exclusion of the percussions, to the exclusion of the strings. They all work together, and when one of those pieces is off, you have some harmonics that aren't going to be working. The economy won't be working at optimal levels, but they are all tied together. And to this day, we see it as it's all tied together to make this beautiful economy of ours function.
So what was your instrument of choice?
Trombone.
Trombone. Okay, I was a trombone.
Oh yeah, trombone.
Myself.
It was very sexy. Slide trombone. I tell you what.
Good. Okay, so this is just so much good information. I do want to give you a little bit of a room to tease as much as you want about the webinar. That again, we'll have links in the show notes, and obviously highly recommend everybody go check that out. So let's just let you kind of give a little bit of a preview of what you went over on that webinar, and maybe we can dig into a few of those points here before we wrap up today.
For the webinar, it was primarily focused on the 2030s decade, really through 2036. How we're going to get from here to the top of a long wave, which we think will happen in 2029, 2030, and then what that slide down is going to look like. And we're calling it a depression. It is the coming depression. We see a decline that isn't one precipitous drop, but rather think about a slope you would go sledding down when you were a kid. You know, I'd have some steep spots, and then it would level off a little bit, and then you have another steep spot. But one lasting 6 years is what we see for this decline in the economy that is coming up. And a lot of it is tied to healthcare costs, demographics, entitlement spending, and how that all wraps up into the national debt. And we took each one of those apart, and we looked at how those trends are likely to build over the next 10 years, 8 years, and how they're likely going to culminate in this 6-year period of difficulty. But at the same time, you know, we like to tell people, look, we're telling you this not to scare the daylights out of you. We're telling you this so that you can be ready for it, right? We have so many more social safety nets today that we had versus what we had in the 1930s that it's silly to say it's going to be like the 1930s. Of course, it's not going to be. But it's still going to be an extremely difficult period. So let's say that you're dealing with 20% unemployment, just to grab a number, okay? You can focus on that if you want to, or you can do what I choose to do and say, all right, that means there's 80% employment. So what is my business going to be about that caters to the 80%? Who will they be that are still employed? Mm-hmm. And I think more importantly for me is, what do I tell my kids and my grandkids? What should they be thinking about? What should they be studying? What should their occupations be in order to still be successful during the 2030s? You know, most people don't realize that more millionaires were made in the Great Depression than any other time. Mm-hmm. There's always a way to make money. You can choose to go with the herd, or you can choose to go your own path, use the trends to your advantage, or succumb to the trends. You know, you always have those choices, and we're just trying to educate people into what those alternatives are going to be, what those trends are. And that's really what we tried to get across during that webinar.
Yeah, I think that's what's so fascinating is the ability to take whatever perspective you want into that, right? It can be the focusing on like you said, the 20% unemployment, or how do you position to make sure that, knowing that now that you have this information, right, assuming that we're able to make sense of that information on a forecast, how do you position, how do you make those changes, how do you get ready for what that looks like, and make sure that you're not, you're not going to be affected as badly as you could be, but you're positioning things to be able to even maybe take advantage of it, given what that looks like going forward. Obviously, we don't know what that's going to look like entirely. But yeah, the more information you can have and the more runway you can get to start setting up for some of those decisions, I think is a really good piece of information to have. So, again, super, super grateful. You've been so generous with your time. We will absolutely put some links in the show notes. Highly, highly recommend listeners to the show go check out that webinar for sure. And Brian, I guess if listeners want to learn more about what you're up to at ITR, how can they get a hold of you, or what's the best way to keep tabs on the great information you all are putting out?
Just go to our website. There's a lot of free content there, and there's a lot of material. You can see where Alan and I or the other speakers are going to be through the rest of this year, and maybe you can catch one of those venues. There's all sorts of ways to stay on top of all of this. And Adam, I've really enjoyed talking with you. Sometimes I don't get people that see things as clearly as you do, so you've been a joy.
I'm curious, since you mentioned the business travel is starting to come back. That's one of the things that we're trying to figure out right now is what does our conference schedule look like going forward, trying to come out of the COVID shell of virtual meetings. I'm curious, how are you all looking at conference travel? Is that something you're seeing come back? We've started to see a few in the real estate space come back. Some mixed attendance, some have been wildly over attended based on what they've been historically, and some have been 30% attendance. I'm just curious how you're seeing business travel, as I know that's something that a lot of us are trying to figure out right now.
It's slowly coming back. If I had to spitball a number, Adam, I'd say it's about 25% for the rest of this year, what we would call a typical year. But we're also seeing where people are booking much more closely out than they used to. So we don't have the same visibility that we used to have. They're trying to figure it out themselves. Yep,
that sounds accurate to our our sample size of one over here. So pretty much right online. Well, Brian, again, this has been a blast. We really, really, truly appreciate you coming on. Thank you so much for your time. And listeners, again, check those show notes for that webinar and everything Brian and the team are up to at ITR Economics. So thank you again for coming on today.
My pleasure. Thank you.
All right, listeners, that's all we've got. Hopefully you got some good nuggets in there. I know it's a lot of information. If you have any questions for us or for Brian, send us a note to podcast@realcrowd.com. And with that, we'll catch you on the next one.